there's a very important metric. If you're developing a trading strategy or a trading system, one of the key metrics to pay attention to is a metric called the expectancy ratio. The expectancy ratio gives you an idea of how profitable your trading system is. Okay? And it is calculated by you take your risk reward ratio, you multiply it by your win ratio, and then you subtract the loss ratio from it. Now, there are different variations of this formula, and you can check it out online. But the key thing is you must have a very clear understanding of what the expectancy ratio of your trading system is. Okay? In this regard, you are always looking for an expectancy ratio that is at least above 1, 2, 3. Okay? If you have a negative expectancy ratio from your trading strategy, that means your strategy is losing money and will continue to lose money for the long term. Okay? So the expectancy ratio is a metric that factors in your risk reward ratio, it factors in your win ratio, okay? It factors in your loss ratio, and it takes all of these different elements and computes the expectancy ratio from it. Okay, so that's why it's a very strong metric, because it factors in all the different elements that make up a profitable trading strategy or a trading system. Okay, so when you're looking at your win ratio, you're simply trying to get what's your average profit per trade. When you're looking at your loss ratio, what's your average loss per trade? When you're looking at your risk reward ratio, am I gaining more than I'm losing per trade? That's what your risk reward ratio is. Okay, so the expectancy ratio allows you to have a detailed look into those different elements. And if you have a negative expectancy ratio, it simply means your trading strategy is losing money or will lose money. Now, the tricky part with this situation is you may implement a trading strategy that will end up net profitable. Okay? You may make some profit on that trading strategy. But when you go into detail to compute the expectancy ratio, you will find that your trading strategy, the one that has given you profits, comes up negative. You end up having a negative expectancy ratio. That means your trading system is only profitable for the short term. If you continue implementing it, it will end up losing money in the future. That's very, very important to understand. Okay? But how do we measure it properly? First of all, you must have a trading system and a trading strategy. That's a whole other video and a whole other topic in itself. Now, you must execute that trading system on a series of trades, not on 1 or 2 trades or 3 or 4 trades. Okay? You must have a statistically significant sample size on which to execute that trading system. Okay? You cannot execute a trading system on 5 trades and say your trading strategy is profitable. You cannot execute your trading system on 3 trades, 4 trades, or even 10 trades and say that you have a profitable trading system. No. You must have a sample size that is large enough, that is statistically significant for you to be able to measure the metrics effectively and properly. Now, in this case, at least 25 trades or 30 trades. Okay? That will give you a good enough sample size to be able to extract the right metrics from your trading strategy. Okay? So once you have that, you have a trading strategy, you've executed it on a good sample size, then compute the expectancy ratio. Okay? You can do it manually if you're doing it on a demo account. Some softwares allow you to do it automatically. Information is freely available. You can go get it. But it's a very, very key metric to study. Very, very important metric. A lot of times, so many traders bring strategies to me. They tell me this strategy uses support and resistance. It uses this particular technical tool. This indicator works. I say, okay, that is well and good. What are the metrics? What are the numbers? What is the expectancy ratio? They cannot tell you. They don't know. Okay? You even ask them, okay, what's your win ratio? They don't know. You ask them, what's your average profit per trade? They don't know. Okay? Yeah. So just because a technical tool works, that doesn't mean it's going to give you profit. Or that doesn't mean you are using it in a way that will generate profit for you. Very, very important. So while you're trading your strategy, the key takeaway from this video is compute the expectancy ratio, have a clear trading strategy, execute it on a large enough sample size, improve the expectancy ratio, make sure it's always positive for the long term, and keep on monitoring it to improve it. All the best.